Gold just did something it has not done in 45 years. It doubled in 12 months. On January 28, 2026, gold touched $5,589 per ounce. That is a 100% gain in 1 year. The last time gold pulled off a move like this was 1980, when the world was falling apart. Inflation was crushing the middle class. The Soviet Union had just invaded Afghanistan, and the Iranian hostage crisis was dragging on with no end in sight. Fast forward to today. We have record debt. We have frozen Russian assets. We have tariff threats flying in every direction. And central banks are buying gold like their survival depends on it. Because maybe it does. In 2024, central banks purchased over 1,000 tons of gold. They did it again in 2023. They almost did it again in 2025, adding 863 tons. This is not normal. For context, between 2010 and 2021, central banks bought an average of 473 tons per year. We are talking about more than double the historical average for 3 straight years. And yet when you ask officials why they are doing this, you get corporate speak. You get diversification, you get long-term strategy, you get hedging against uncertainty, but nobody wants to say the quiet part out loud. Nobody wants to admit that the system we have been living under for the last 50 years might be breaking. What is driving the gold explosion? Let me show you the numbers that Wall Street does not want you thinking about too hard. Gold climbed to a fresh all-time high, crossing $5,100 an ounce on Monday, January 27, 2026. By the end of that week, it hit $5,589. This was not a slow grind. This was an explosion. In the first 3 weeks of 2026 alone, gold added roughly 12%. Over the past year, it surged about 65%. And in 2025, gold set 53 new all-time highs. Think about that. 53 times in 1 year, gold broke its own record. That is more than once per week. Now, the mainstream narrative will tell you this is about geopolitical risk. Trump threatened Iran. Trump captured the Venezuelan president. Trump threatened tariffs on Greenland. All of that is true. But geopolitical risk has always existed. What is different now is the financial plumbing underneath the system. For years, crypto thrived on cheap cash. When interest rates are low, money is trash. You do not want to hold dollars. You want to hold assets. The same logic applies to gold. But in early 2026, something strange happened. Gold started rising even when real yields were high. Historically, gold and real yields have an inverse relationship. When real yields go up, gold goes down. When real yields go down, gold goes up. This makes sense because gold pays no interest. If you can earn 5% risk-free in treasury bonds, why hold a metal that generates nothing? But in 2025, that relationship broke. Gold rallied during periods of elevated real yields. This tells you something fundamental has changed. The opportunity cost of holding gold still exists, but it is being outweighed by other variables: geopolitical hedging, sovereign diversification, and the creeping realization that the dollar-based system might not be as stable as everyone assumed. Why central banks are buying like never before? Let me walk you through the buying spree. In 2022, central banks purchased over 1,000 tons of gold. They did it again in 2023. They did it again in 2024. Since 2022, annual central bank purchases have been more than twice the 2015 to 2019 average. Central banks now account for nearly 25% of total gold demand. In 2015 to 2019, that number was 12%, and the buying is not slowing down. In the fourth quarter of 2025, central banks added 230 tons. That is a 6% increase from the previous quarter. Full-year demand for 2025 came in at 863 tons. Yes, that is lower than the 1,000-ton threshold we saw in prior years, but it is still 82% above the 2010 to 2021 average. Here is what makes this interesting. Gold prices hit multiple record highs throughout 2025, yet central banks kept buying. This shows they are not waiting for dips. They are not trying to time the market. They are accumulating regardless of price. That is not the behavior of traders. That is the behavior of institutions preparing for structural change. Who is buying? The National Bank of Poland was the largest buyer for the second consecutive year, adding 102 tons in 2025. Gold now accounts for 28% of their total reserves. And their governor said he wants to increase holdings even further to 700 tons for national security reasons. The National Bank of Kazakhstan increased gold holdings by 57 tons over the year. That is the highest level of annual buying on record going back to 1993. China extended gold purchases for the 15th consecutive month in January 2026. The People's Bank of China is not disclosing the exact amounts anymore, but the trend is unmistakable. And this is not just emerging markets. According to a World Gold Council survey, 95% of central banks expect global official gold reserves to increase over the next 12 months. That is the highest level of optimism in the survey's 8-year history. Even more striking, 43% of central banks indicated plans to increase their own gold holdings, up from 29% in 2024. And 0 central banks said they plan to reduce holdings. Let that sink in. Not a single central bank surveyed said they plan to sell gold. That is unprecedented, and it tells you where we are in this cycle. We are not at the end, we are at the beginning. The dollar crisis nobody wants to admit. Here's the part that makes central bankers uncomfortable. The dollar is still king. As of the third quarter of 2025, total global foreign exchange reserves stood at about $13 trillion. The US dollar's share of disclosed global currency reserves was just under 57%. That is down from over 70% 2 decades ago, but it is still dominant. However, the marginal trend is what matters. U.S. Treasuries held at the New York Fed on behalf of foreign central banks fell to $2.72 trillion in December 2025. That is the lowest level since 2012. If big holders want less exposure to U.S. risk, diversification follows, and gold is the obvious alternative. Why? Because after the Russia-Ukraine war broke out, Western countries froze over $300 billion worth of Russian sovereign assets. For any country watching, that was a stark reminder. If the asset is held inside someone else's jurisdiction, it can be taken, and things escalated from there. In recent months, the EU has been using profits from frozen Russian assets to help fund Ukraine's efforts. This weaponization of the dollar is driving demand for neutral assets. Gold does not rely on another government's politics or legal system. It cannot be frozen by executive order. It cannot be seized remotely. It works in a blackout. It works in a war. And most importantly, it works when trust in the system breaks down. Central banks are not accumulating gold because they hate America. They are accumulating gold because they witnessed what happened to Russia and realized they could be next. Every sanction, every freeze, every political weapon deployed through the financial system erodes trust. And when trust erodes, gold wins. What Wall Street is predicting. The investment banks are now scrambling to update their forecasts, and the numbers they are throwing around would have been laughed at just 2 years ago. JP Morgan expects gold to hit $5,055 per ounce by the fourth quarter of 2026. By the end of 2027, they see $5,400. Goldman Sachs recently lifted their December 2026 forecast to $5,400, up from $4,900 previously. But wait, there is more. JP Morgan now predicts gold could hit $6,300 by the end of 2026. Deutsche Bank believes prices will top $6,000 by year-end. UBS predicts $6,200. Societe Generale is calling for $6,000. These are not fringe analysts. These are the biggest banks on Wall Street, and they are all saying the same thing. Gold is going higher, a lot higher. The reason is simple. Demand is outpacing any reasonable expectation. JP Morgan forecasts that investor and central bank demand will average 585 tons per quarter in 2026. That breaks down to around 190 tons per quarter from central banks and 330 tons per quarter in bar and coin demand. Central bank purchases are expected to hit 755 tons in 2026. That is lower than the peak years of over 1,000 tons, but still elevated compared to pre-2022 averages of 400 to 500 tons. And the slowdown is mechanical, not structural. With gold prices above $4,000 per ounce, central banks do not need to buy as many tons to hit their allocation targets. If you want gold to be 20% of your reserves and the price doubles, you automatically hit your target without buying a single ounce. But here's the kicker. Goldman Sachs estimates central bank purchases are now averaging around 60 tons per month. That is far above the pre-2022 average of 17 tons per month. The structural shift is real, and it is not reversing. The retail investor wave is just starting. Central banks are not the only ones buying. Retail investors are piling in too. And this is where things get truly explosive. In 2025, global gold ETF holdings grew by 801 tons. That was the second strongest year on record. Bar and coin buying accelerated to reach a 12-year high. In the fourth quarter of 2025 alone, ETF inflows totaled 175 tons. Bar and coin demand hit 420 tons in Q4, a 12-year high for the quarter. Total gold demand in 2025, including over-the-counter transactions, exceeded 5,000 tons for the first time in recorded history. Chinese investors led the charge. They piled into gold funds at a record pace in 2025, with China driving a large share of global gold ETF inflows. Why? Because they do not trust their own currency. They do not trust their own stock market. They do not trust their own government bonds. Gold is the escape hatch. Western investors are waking up too. After years of ETF outflows, Western investment demand for gold has decisively returned in 2025. Gold ETF holdings climbed by about 500 tons since the start of 2025, and here is the critical point. Gold ETF holdings remain well below previous peaks. That means investor engagement with the asset class still has room to normalize relative to historical levels. Put differently, we are not at peak mania. We are at the early stages of a structural reallocation. Gold's share of total global financial assets has increased since 2010, rising to about 2.8% in the third quarter of 2025. That is still tiny. For comparison, global equity markets are worth about $100 trillion. If just 1% of that shifts to gold, you are looking at $1 trillion of new demand, and there is only about 216,000 tons of above-ground gold in the world. Only 17% of that is held by central banks. The math does not work. There is not enough gold to satisfy demand at current prices, which means prices have to rise. A lot. The geopolitical trigger that changed everything. Let me show you the moment that broke the dam. On January 28, 2026, gold hit $5,589 per ounce. That was the day tensions between the US and Iran escalated to the brink. Trump threatened a major strike on Iran after the government violently cracked down on protests. Iran refused Trump's conditions for discussions, which included limiting the range of their ballistic missiles. But that same day, something else happened. The Federal Reserve decided to hold interest rates steady at 3.5 to 3.75%. Markets had been pricing in rate cuts. When the Fed held, it should have been bearish for gold. Higher rates mean higher opportunity cost for holding a non-yielding asset. But gold exploded anyway. It rose over $300 in a single day. This is the new paradigm. Gold is no longer just reacting to interest rates. It is reacting to trust, or more accurately, the lack of it. The US dollar has been falling, inflation is sticky, tariffs are being threatened on longtime allies like Canada, Mexico, and the EU. Trump captured the Venezuelan president. He threatened military action to acquire Greenland. These are not the actions of a stable superpower managing a predictable world order. These are the actions of a government making it up as they go. And when the world's reserve currency issuer starts acting erratically, capital flees to safety. That safety is gold. Even more revealing, a criminal investigation was opened into Federal Reserve Chair Jerome Powell. Whether that investigation has merit is irrelevant. What matters is the signal it sends. The independence of the Federal Reserve is being questioned. The institution that manages the world's reserve currency is under political attack. That is not bullish for the dollar. That is catastrophic for the dollar. The debt bomb that makes gold inevitable. Let me show you the elephant in the room that nobody wants to discuss. According to IMF figures, total global debt is just above 235% of world GDP. That is around 251 trillion US dollars. When debt sits that high, there is a growing assumption that governments will manage it by keeping interest rates low for long stretches and letting inflation relieve the real weight of that debt. This is the debasement trade. Governments are now forced to let inflation steadily eat away the real value of their currencies over time. This is why you may have seen the term financial repression thrown around recently. That just refers to policies that suppress what savers earn relative to inflation. If you are a central bank holding foreign bonds as reserves, that is a dynamic that makes a larger gold allocation look attractive. Think about the math. The United States has $38.5 trillion in national debt. Interest payments alone consumed $1.22 trillion in fiscal year 2025. That is more than the entire military budget, and it is growing exponentially. Every time a treasury bond matures, we have to issue a new one to pay it off, and that new bond carries a higher interest rate than the old one. This is the debt spiral. Higher interest rates mean bigger deficits. Bigger deficits mean more borrowing. More borrowing means more supply. More supply means lower bond prices. Lower bond prices mean higher yields. Higher yields mean even bigger interest payments. It feeds on itself, and there is no exit ramp that does not involve either default or inflation. Central banks see this. They understand the endgame. Either the US government defaults on its debt, which is politically impossible, or the Federal Reserve prints money to buy the bonds that nobody else wants, which is inflation by another name. Either way, the dollar loses purchasing power, and when the dollar loses purchasing power, gold wins. This is not speculation, this is just math. And central banks are voting with their wallets. They are trading paper promises for hard assets. They are trading IOUs from a government drowning in debt for metal that has held value for 5,000 years. Why gold keeps breaking the old rules? For decades, the playbook was simple. When the economy slows, the Fed cuts rates. When rates fall, gold rallies. When the economy heats up, the Fed raises rates. When rates rise, gold falls. This relationship was so reliable that traders built entire strategies around it. But in 2025, that playbook was shredded. Gold rallied even as real yields climbed. Real yields are what you earn on treasury bonds after subtracting inflation. They represent the opportunity cost of holding gold. When real yields are high, gold should struggle. When real yields are low or negative, gold should thrive. That was the rule. But the rule is dead. Why? Because the drivers of gold demand have fundamentally changed. It is no longer just about inflation hedging or interest rate policy. It is about systemic risk. It is about the weaponization of the financial system. It is about the loss of faith in institutions. And you cannot model those factors with a spreadsheet. When Russia's assets were frozen, central banks around the world took notice. If it can happen to Russia, it can happen to anyone. That realization shifted gold from a tactical hedge to a strategic necessity. And strategic assets are not traded on price. They are accumulated regardless of cost. This is why central banks kept buying even as gold hit record highs throughout 2025. They were not trying to time the market. They were trying to insulate themselves from a system they no longer trust. And when trust breaks down, price becomes irrelevant. The silver explosion. Nobody is talking about. While everyone is focused on gold, silver is quietly staging its own historic rally. Spot silver jumped 6.9% to $111.11 an ounce in late January 2026. It hit a record high of $117.69 on Monday, January 27th. Silver has surged more than 55% so far in 2026 after recording a 146% gain in 2025. Why does this matter? Because silver is both a monetary metal and an industrial metal. It is used in solar panels. It is used in semiconductors. It is used in electric vehicles. Demand is structural, and supply is constrained. Bank of America now has a price target of $170 for silver. Citi upgraded their short-term silver forecast to $150 from $100. Silver is more volatile than gold, but it also has more upside. When gold moves, silver moves faster, and right now, both are moving in the same direction, up. What happens next? So where does this go? The short answer is higher. The structural drivers are intact. Central banks are not done buying. Retail investors are just getting started. Geopolitical uncertainty is not going away. And the dollar-based system is creaking under the weight of its own contradictions. JP Morgan sees gold potentially hitting $6,300 by the end of 2026. VanEck sees gold potentially reaching $5,000 by 2030. But here's the thing. Those forecasts assume the system holds together. They assume no major financial crisis. They assume no currency collapse. They assume the dollar remains dominant. What happens if those assumptions are wrong? What happens if the trust in the dollar erodes faster than expected? What happens if more countries freeze each other's assets? What happens if the weaponization of the financial system accelerates? In that scenario, $6,300 is not the ceiling, it is the floor. Some analysts are now talking about $10,000 gold. Some are talking about $40,000 gold. These numbers sound insane. but they are not impossible. In 1980, gold hit $850 per ounce. Adjusted for inflation using the official CPI, that is about $3,200 today. But if you adjust using the methodology the government used back then, it is closer to $10,000. The point is this: gold has already broken through its inflation-adjusted all-time high from 1980. We are in uncharted territory, and the forces driving this rally are stronger than they were in 1980. Back then, it was inflation and geopolitical chaos. Today, it is inflation, geopolitical chaos, weaponized finance, record debt, and a crisis of confidence in the institutions that manage the global monetary system. The buying is not stopping. In November 2025, central banks were net buyers again, with reported purchases still elevated. And from early price action in 2026, demand is still strong. For the first time in decades, gold is not just a hedge, it is becoming a core holding. Central banks are treating it as strategic infrastructure, retail investors are treating it as insurance, and institutions are treating it as a neutral reserve asset in a world where trust is evaporating. The question nobody wants to answer. Here is what central banks will not say out loud. They are preparing for a world where the dollar is no longer the undisputed king. They are preparing for a world where sanctions and asset freezes are routine. They are preparing for a world where holding another country's debt is a liability, not an asset. Gold does not care about politics. It does not care about sanctions. It does not care about who wins the next election. It just sits there, heavy, shiny, indestructible. And most importantly, it cannot be printed. It cannot be debased. It cannot be hacked. It cannot be frozen. That is why central banks are buying. That is why retail investors are buying. That is why the price is exploding. Because in a world of infinite fiat currency and weaponized finance, gold is the only thing left that everyone trusts. The explosion in gold is not a bubble. It is a repricing of risk, a repricing of trust, a repricing of what money actually means in a system where the old rules no longer apply. And the scariest part? This is just the beginning.